Hey everyone, and welcome to Investing with Dominic. This is the first episode of our video series, and we're going to cover a lot of really cool stuff in this channel. But I thought we'd start today with something simple. How do we think about whether to buy a stock? Before I forget, if you're interested in learning more about investing, please don't forget to subscribe to the channel so that you get alerted when I post new content. The button is right below. Now that we've got that over with, let's continue. Quick side note for those of you who are brand new to investing. A stock represents a piece of ownership in a company. So when a company needs to raise money, they sell a piece of ownership to public investors on a stock exchange. So this is a really cool idea because you or I as individuals can then go and buy a piece of one of these companies. It applies to very big companies such as Apple, Google, Microsoft, all the ones you've heard about before. So this is a pretty timely event because 2020 was a huge year for the stock market, where not only were returns very high, but there was a lot of volatility as well, meaning it jumped around quite a bit. So there were just tons of opportunities for individuals to jump in and buy things they were interested in. So what we're going to be going through today is how I would think about whether or not to buy a stock. What do I look for? How do I evaluate it? And what are some of the tools that I would use to make a decision? Okay, a couple words on the general approach. In my experience, a lot of people will recommend you use methods or models that are just way too technical. They either zero in on details that are not relevant for how a company is going to perform in the future, or they're too hard to measure accurately. So what we want to do is we want to establish a process that is repeatable, simple, and that we can believe in, and we're not trying to measure things that we don't really have any business trying to measure. So when we think about whether to buy a stock, we need to figure out three things. One, what does the company that the stock represents do? How does it make money? And we need to make sure we can understand its business. Two, we need to figure out how the company is currently doing financially. So there's a lot of really good resources that are free and they're online, and I'll show you how to get some of these as we go through a different section of the video. But there's a lot of really good resources out there, and I think you'll be able to find everything you need pretty easily. Finally, we need to make some conservative assumptions about how we think the company's going to do in the future. And we can walk through a few examples of these in just a little bit. We don't need to predict exactly, company X is going to do 10% return exactly with, whatever number of dollars of expenses in such and such year. We just need to get kind of close, and then we can err on the side of safety so that we're reasonably confident in what we're dealing with. All right, let's get right into it. What you see on the screen in front of you is everything we need in order to make a decision. We've got a few tabs open in a browser, and I also have an Excel model down here that I built just for this purpose, and I'll show that to you in 1 second. So back to the browser briefly. I've got targets page up on Yahoo Finance. This gives a nice little snapshot of a lot of relevant information you need to know. Morningstar, this is the free version, not their membership version. And there's some more very important information we'll be taking from here. And then these are just from Target's investor relations page. Full disclosure, I do own shares in Target. I'm going to make a point of always telling you guys when I own one of the stocks we're talking about. Sometimes I'll just have it in the video, as I'm considering buying something right along with you. But I think it's important to always let you know when I own it as well, because you need to know, where my interests are aligned with and just how I'm thinking about it in general. Couple of things that are going to be important to us. Market cap, that's just the size of the company. PE ratio, that's basically the market cap divided by the company's earnings in a year. And it's just the measure of how we're going to determine how expensive the stock is relative to its earnings. This is also going to be very important. Most of the rest of this we don't care too much about. Dividend, that's going to be important to us, but it's not factored in too much into whether we should buy the stock for appreciation, meaning whether it'll go up or down. Okay, so what we do here is we just try to see how the stock has performed in the past. So you have the 1-year chart up here. In the case of Target, a year ago, it's at 120-ish, drops all the way down to 92 during the midst of the pandemic, and now it's at 191.
not a bad return during that time. All right, let's go over to see what we take from Morningstar. Morningstar, this is the quote page. It gives some of the same information that you'll see on Yahoo, but what we really care about is the financials page. The financials page, as you'll see in a second, was where we take a ton of our information that we're going to use. One thing that's pretty important here is growth. 3-year annualized revenue. So they've grown their sales at 3.59% over the last 3 years. Meanwhile, their net income, which is their earnings, has grown faster than that. That is exactly what you want to see in deciding whether or not to buy the company, because it says that they're executing, not just selling. And you'll see exactly what that means in 1 second. Most of what I take from this page is down here. All I do is I download the income statement, the balance sheet, and the cash flow statement. So you have this big, ugly, hard to use format here. All we do is click export to Excel, and it'll pop up down here shortly. You don't have to look at it now. I've already pulled it for you here. So that's really all we use Morningstar for. Over on the company's investment relations page, this is where we try to make a lot of assumptions. A company like Target, feel pretty comfortable saying we understand its business pretty well. They sell out of their big box stores, and they specialize in discounts on pretty much anything. So typically what I like to look at here is the most recent investor presentation. You don't have to listen to a whole earnings call that's an hour long. All you have to do is download a quick PowerPoint, and they make a lot of the important information pretty easy to find. So comparable store sales, this is an important number. So you can see that for stores that have been open for over a year, sales grew 9.9%. That is absolutely enormous for a retailer nowadays, and it just shows how strong Target's business has been lately. So you'll see where this shows up on the actual financials in a little bit. But they make a lot of stuff pretty easy here. A big initiative is trying to sell more online because it's easier for consumers. And making delivery in general a lot more seamless. You can see same-door services growth up 500%. That's exactly what you'd want to see in a business that sells to consumers just like this. So we're not going to go over all of this. We're just going to jump right into the tool that we use to make a decision on whether or not to buy the company, which is just this Excel model here. Now, a lot of numbers on the page. I'll show you which ones are important. Over here is where I downloaded everything from the website, and it looks like this. I just have formulas over here in all the cells in gray that link to the income statement, balance sheet, and cash flow. So all you see here is the income statement over the past 5 years. This level of data is free on Morningstar. I find it's pretty much everything you need. You don't need too much more than this. So what's important, though, is we've got a bunch of percentages down here. We can see how fast they've been growing revenue, and we can see for each dollar of revenue how much money they actually make on those sales. So what I do over here, last year for which we have data is 2020. TTM means trailing 12 months. All I'm doing over here is I'm making assumptions in these beige cells about what I think the future is going to look like. So we can take a look at exactly what's happened in the past, and then we can try to make a conservative guess about what's going to happen in the future. So let's get right into that. Over the past few years, they've grown their revenue, low single digits, pretty much less than 5%. But then 2020 happens, and over the past 12 months, their sales jump to 13.5%, basically. That's largely a function of more people shopping at Target online and the enormous sales momentum that's been happening as people eat at home. They don't go to restaurants as much. And for a variety of reasons, I actually think that trend is going to continue in the future, especially now that the company's just getting so used to making it easy for its customers. So we'll make an assumption that, over the next 5 years, they'll probably be able to grow sales a little bit more than the typical low single digits. We're going to say they can grow sales maybe about 5%. Gross margin, that's just their variable costs. So Target sells a banana. How much did it cost them to supply that banana to you? And that's the amount of money they make on that. So all the numbers up here in blue are calculated off of these percentages. So moving on, SG&A. SG&A is just your administrative costs. So how much does it cost to pay the corporate people? How much for advertising? A whole laundry list of stuff there. And we just make an assumption about what percentage of the revenue do they need to incur in expenses. Logically, this number should grow slower than sales because while it might take advertising to grow sales, you generally don't need to hire more administrative people to grow sales. That's what we call leverage. That's exactly what we want to see in a well-managed business. And then interest costs, this is just an assumption about how much they pay on their debt. Down here is where I actually pulled their debt levels. So I just assume 5% because interest rates are pretty low. And then the tax rate, this is pretty tough because a lot of companies manage their tax rate pretty well. So what I'd like to do is I just like to set it equal to the last year of data, or if it's pretty consistent, the last 3 years of data. So we'll obviously have to change these numbers if any kind of new tax law gets passed. But for now, we'll just leave it equal to this. So this will factor in later if that does become a reality. So what we care about is this number in yellow. If we're going to buy the stock and hold it for 5 years, what are those earnings going to look like in 5 years? Because you'll see very shortly, this is how we determine how valuable the company is. So what we look over here is this is how we're going to determine how well they're going to be executed over those 5 years. Typically, you want to see this gross margin go up over time. Typically a good way to figure out if that's going to happen is, have they done it before? And Target's, it actually stays, pretty constant. It stays right around 29%. Last 12 months, it's been in the low 29. So if we're going to be conservative, we should probably keep it right around there. There's no real reason to say it's going to necessarily go up. If you really want to get aggressive, you can maybe add 1% to it by the time you get here. Like I said before, SG&A, that's your administrative costs and marketing and everything like that. That stuff, it should grow slower than revenue. So by keeping it at a constant percentage, I'm basically saying it's going to grow at the same rate as revenue. We'll see if we can, move that number around a little bit as we go forward. And then interest costs and depreciation, I'm not really going to touch those. They're small dollars anyway. So all I'm doing is over here, I'm plugging in the current value of the company. I get that from right here, their market cap on Yahoo. And I'm plugging in the calculated future value. How do I get that? I take the PE ratio multiplied by the earnings. That gives me the future value. And then the number that we really care about is this, which tells us if they grow their earnings at this rate, as we've modeled out here, how much are we going to earn per year by holding Target stock? So making a variety of conservative assumptions, it doesn't look that great. We don't really want 2%. We want something like 10% while being conservative, because that tells us we have upside. So one thing we should examine is I actually lowered the PE ratio. Remember, that's the amount that the company's worth relative to its earnings, down to 20. If you look at Yahoo, it's currently at 25. PE ratios are very hard to forecast, and they depend on a lot of different things. Remember what I said in the intro. We don't want to forecast things that we don't think we can accurately forecast. So I typically drop it down from its current one to be conservative. However, watch what happens to our rate of return if in 5 years they sell at the same PE ratio that they sell at right now. An entirely possible scenario. 25, our return goes all the way up from 2 to 6 per year. All right, well, let's see if we can do other stuff. Remember, I said we're going to grow administrative costs slower than we're growing sales. So this percentage should go down over time. Let's just say in 5 years that it's going to be 5% less than it is right now, which I would say is a pretty conservative assumption as well. Now, that really does a lot because Target's profit margin is relatively low. It's about, 4-ish%. So that means any change you make here is going to have big implications to their bottom line. If they're able to get it down to about 15% of sales, we could make 20% per year. Well, that number starts to look really, really good. Do they have a track record of lowering the percent of sales? Not really, but you can make an argument that now that the company's pretty big as a result of all these recent sales, they really should be able to make some progress there. Let's not be quite so aggressive. Let's just take out 2% rather than 5%. Gets us to 12% return over the next 5 years. So as you see, we just went through that whole thing in not too long. And by picking a business that we think we can understand well, Target, because they sell at stores that we've pretty much all been to, we can make some conservative assumptions about how well we think they're going to do in the future. I don't consider the 25 too big of a risk in this case because of how low interest rates are. And generally, if interest rates are low, stock prices as a relative to their earnings go up, meaning higher PE ratios. So if we keep the same PE ratio that they have today in 5 years, that's an entirely possible scenario. If we take out a couple of those, drop it down to 23 or something, we go down to 11% a year. So basically, if we're going to be super conservative, even after how much Target has gone up recently, there's still upside based off of this look towards how we can do in the future. So all in all, a good story.
That's all for today. If you're interested in learning more about investing, please subscribe to the channel so that you get alerted whenever I post new content. The button is right below. That's all for now. Bye.